I hope you appreciate that the sustainability of the existing financial system is largely over. And in actual fact, what we're seeing here in terms of gold is a beginning of a major parabola that we expect during the course of this year could still meet the 2,900 doorstep of 3,000. And in the years following, we have targets to 4,500, 6,800 and beyond as part and parcel of a collapsing fiat system. Remember the football that's collapsing and inflating the new digital system, all going into the physical realm that is unencumbered by debt. Which one do you want to be? You want the physical realm, and you want the asset that comes with no liability statement on it. In 100 years' time, that bar of gold is still a bar of gold.
In the past 50 years, the US dollar has lost over 80% of its purchasing power compared to the Swiss franc, and this trend seems set to continue. As a result, individual investors, large institutions, and governments are increasingly turning to precious metals, especially gold. Gold's role as a reliable store of value and safe haven is driving demand. The recent price surge from around $2,000 to $2,400 is the beginning of a longer bull market. FrancisHunt, renowned as the market sniper, explores the current financial collapse and emphasizes the significance of gold investments. In his analysis, FrancisHunt predicts a significant rise in gold prices, reaching up to $6,800 in the future as fiat currencies collapse. He highlights a significant shift from US Treasuries to gold in global investments. Hunt further explains that despite a strong US dollar, the Treasury market has declined by 45% since March 2020, impacting countries holding US debt. Gold set a fresh record of a 15% return this year alone. Analysts point to central banks' purchases as a major force propelling gold's surge. China, for instance, has topped up its gold holdings for 18 consecutive months, while scaling back its stockpile of US Treasuries. Comparing the US to Japan, Hunt explains that Japan has allowed its currency to devalue to maintain its debt value. At the same time, the US has chosen a different approach, leading to a devaluation of its debt assets. He believes that both nations are engaged in financial manipulation, each choosing other methods to manage their substantial debt and economic challenges. US general government debt will continue to rise, having resumed an upward trajectory last year after improving in 2021 and 2022 due to the economy's quick post-pandemic recovery and elevated inflation. Despite forecasts of moderate economic growth, debt levels are projected to increase, reflecting ongoing fiscal challenges. Now, we present the clips of FrancisHunt's insights from his recent video with ITM Trading. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
Here's a little bit of an idea for you from Tavi's tweet or post on X. That's what they're doing on the US Treasuries. They are letting go of the standard investment for the globe, the US Treasury market, a 10-year T-bill, a 30-year T-bill. These things are being divested from. That means people are selling out of that instrument. And I'll come to why in a minute. What are they buying in lieu of treasuries? The white line. That is the line that is gold. This is showing a chronic accumulation of gold at the expense of treasuries, a disaccumulation in treasuries. That is a very, very important and dangerous trend by the single largest manufacturer of all things that the world, not just America, is consuming. And they are grabbing ever greater positions in other markets such as car making and product champions in all categories that they didn't have before. So, further on, as we move in, what has this meant? So the dollar's been strong, great. But what has this meant for the US Treasury markets? And you might remember that as the gold high. Move up into the 2020 period, March 2020. You all know what happened in and around that particular period, and a subsequent 45% collapse in treasuries. That means nations that held the US Treasury debt has lost nearly half in the 4 years since the great pandemic that everybody is pretty familiar with. So with the devaluation of debt, the currency has gone up, but we'll be pointing out soon how both categories of assets have in fact. So when people look at dollar dominance, they often only tend to have a look at the one half of the fishbowl and not see the cost of events around that. I can point out to you that the second biggest pension fund, the California Teachers Association, couldn't sell their debt. They didn't have sufficient yield to meet pensions, so they had to sell debt. The market was deemed unfavorable for selling that debt. Unfavorable. I'll leave you to determine what that actually means. That they borrowed against their debt to make the pension payments. So now they were adding further debt against their asset of debt that they couldn't sell in suitable conditions to get the money they needed. They're now borrowing against this questionable collateral in lieu of not wanting to sell while it's in a low point. So many people view the half fishbowl and they go, awesome, dollar up, without mentioning that pensions and so many other things rely on the asset of US Treasuries to be maintaining value, and the heavier guy is deeply underwater, as illustrated in the Substack. Now, some of you will go, oh, well, at least we're not Japan. Well, Japan has done the exact opposite. They've let the pressure of their currency be the release valve, and the yen has devalued. So the fat guy is on the left-hand side, with the yen being the whipping boys of the first world nation currencies. However, their debt has been retained. You can choose which part of the seesaw you are manipulating, because both are engaged in manipulation. So the Japanese treasuries should be allowed to devalue more, and the US market's dollar should relatively probably be devaluing a little quicker. But they've both chosen, of the two taps available, different ones for releasing the pressure of an ongoing parabolic increase in debt and terrible finances, both Japan and America. So whilst there's bragging rights for the USD JPY to be saying, look how much better we are than Japan, it is a bit of a fake victory in lieu of when you consider the devaluation in the debt assets of America versus the Japanese, although both should be going down as well.
During the interview, FrancisHunt emphasized that people often buy gold when prices are rising, driven by FOMO, which leads to purchases near highs before corrections. Regarding China's pause in gold purchases, Hunt suggests it aims to deter retail investors, potentially enabling central banks and large funds to buy at lower prices. Gold prices are modestly up, and silver is sharply higher in early U.S. trading on Thursday. The precious metals bulls are more confident late this week, following the weaker U.S. retail sales report earlier this week. A Barron's headline today reads, "The Fed needs to cut rates eventually amid this economic slowdown." Despite recent pullbacks, Hunt noted that gold's correction cycles are getting shorter and less severe, indicating a trend toward rapid increases. He further anticipates now is an optimal time to invest in gold, as the upward trend is likely to continue and become more parabolic. Let's get back to the interview.
Most people purchase gold when it is seen to be going up. This is what I call the FOMO effect, the fear of missing out, or the certainty effect. You want to buy something that's already moving in the direction you want it to go in. In actual fact, this often turns into being close to relative localized highs before a small pullback and correction. Here's the gold chart, for example. The last time gold was hitting the headlines and was the main story would have been the 80s when it hit 800. Then 2011, when we hit 1900, just under 1927. And then more recently, we've got a little bit of headlines, but only just when we've been starting to make the 2,500 mark. Now, why would China stop buying? Why would a headline like Bloomberg's come out? China's suspending buying gold. Well, the concern for all the central banks is that the rest of us are noticing that the institutions of central banking and also hedge funds and some of the major informed big investment funds have been purchasing gold at a substantial rate, and we as retail will start doing so too. In fact, if China owns gold, why would they care if retail pushed the prices higher? That would just mean their existing assets are getting stronger. The reason why I feel these articles come out, and they say, look, no more chasing of gold. It's all over. We're all done. That's our 18 months of buying. We just did the surge. That's it. Is because they actually don't want retail to purchase gold. They want the price to ease so that they can recommence acquiring it. When you are a big buyer and your movements are very clear and many people can see you are engaging aggressively in the market to ascertain and to secure a higher gold event, what price for your goods, what actually ends up happening is everyone else starts to chase the momentum. Because initial traders and investors are momentum pursuers. In short, they are looking to do what they think is going to pay for them in the short term, not what's going to be paying for them in the long term. And remember, it's time on the pullbacks to be the buyer. The best time for purchasing would, in actual fact, have been during these periods over here. In the 2000 boom, 99 and 2000, when everybody was talking about internet stocks and how stupid and old world gold was. During the mid-70s, at the end and tail end of the Vietnam War, after all that huge expenditure and just before the French asked for their own gold rather than dollars to be paid to them. More recently, during the Shanghai Accord 2016-2017, when China went and got themselves properly over property leveraged in the property markets of 2016, and the word started to get out of how instead of a China miracle, there'd actually been an absolute boom and binge in expenditure on property investment, their own form of 2008. 2016 was China's 2008. And more recently, in the events of, you guessed it, March 2020, right the way through to the dip sell-off low in the pullback, you could have got in at almost 1600 in 2023. And we are on the shorter time frames. This is a 6-month chart, which takes you right back to the mid-70s that I'm showing you. The best time is actually now. We've had a little period of coming off for gold. Everybody is saying China's done. Most retail are no longer buying because China's not buying and the price is a little bit off. These are your opportunities. And the key element I'm going to make here is that these pullbacks are getting shorter and smaller.
Most analysts have a gold price forecast for 2025 of over $3,000 an ounce. Investors are eyeing gold as a stable hedge against inflation and market turbulence, suggesting a potential for continued growth. With institutional interest and ongoing market volatility, the path ahead for gold appears promising. How will you navigate these opportunities in today's financial system? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.